Silver is being air freighted right now. Citi is talking about $150 in 0 to 3 months. And MKS PAMP SA says silver demand is immense in a way they have not seen before. Tell me that doesn't change the way you look at this tape. If you like these clear, no-fluff breakdowns, subscribe to the Metal Guy. And turn on notifications so the next update finds you the moment it drops. Citi just pushed its 0 to 3 month silver forecast up to $150 per ounce. Meanwhile, MKS PAMP SA is saying silver demand is immense in a way they have not seen before. And at the exact same time, silver is being air freighted because buyers can't wait for ships. Put that together, that isn't noise. That's a market flashing a warning light. And silver is the story right now. From the Metal Guy. If you've been watching metals, you already know we're in a historic stretch. But the last 48 hours delivered something you can't shrug off. Gold is at all-time highs. And within hours, two totally different sides of this market echoed the same message. When those dots connect, the picture gets very hard to deny. Start with the first headline. Reuters reported that Citi raised their 0 to 3 month silver forecast to $150 per ounce from $100. That's a near-term 50% jump, not a someday call. A change like that is Citi quietly telling you the risk profile isn't what it was. Now the second headline. Bloomberg at nearly the same moment ran an interview with James Emmett, CEO of MKS PAMP SA, one of the world's largest precious metals refiners. His exact words, "There's immense silver demand in a way that we've really not seen before." So now the physical side is echoing the paper side, point for point. So the paper side and the physical side are sounding the same alarm at the same moment. That matters. Because when a major bank trading paper futures and a major refiner moving physical metal both say the same thing, you treat it as a signal, not a coincidence. Let's break down why this alignment is so important in plain language. This is convergence. Citi lives in the derivatives market. That world is contracts, positioning, and risk being moved around through paper instruments. They see COMEX positioning, client flows, and hedging activity from institutions. They can spot where the crowd is leaning, where pressure is building, and how fast that pressure can flip into forced buying or forced selling. So when Citi lifts a target by 50% inside a 0 to 3 month window, they're not trying to be loud. They're trying to stay safe. They're effectively telling desks and clients, this move could punish anyone who is short or anyone who is underexposed. That's not social media hype. That's institutional reality. MKS PAMP lives in the physical market. That world is metal, delivery, lead times, and constraints you can't paper over. They refine metal. They facilitate delivery between mines, mints, dealers, banks, and industrial buyers. So when Emmett talks about unprecedented demand, he's not reading candles. He's reading order books. He's watching metal flow. And Bloomberg's interview makes the point clearly. The physical market is under stress like never before. That kind of stress shows up as one sentence. We need metal now. Now, let's anchor this with the data and keep it straightforward. In 2025, silver more than doubled. It was its best annual performance since 1979, a 46-year gap. And in 2026 so far, it's up another 50%. On Monday, silver printed a new all-time high above $107 per ounce, logging its biggest intraday jump since the 2008 financial crisis. As of today, after the volatility, it's trading around 110 to 112. This is not a simple spike and bounce. This is a structural repricing, meaning the market is being forced to revalue silver because the underlying setup is changing. In plain terms, it's not just excitement. It's the system recalculating what silver should cost when supply can't keep up. And Citi and MKS PAMP are both saying the same thing. The drivers behind this are still intact. Emmett described the physical setup in a way that should make you think twice. Retail and wholesale orders are outstripping available supply. Big flows to India are squeezing the global wholesale market. So even when the screen price swings, the real-world pipeline stays tight. And then you get the detail that makes the whole thing click. Silver is now being flown in instead of sea-shipped. Emmett's exact quote, "Now you simply can't wait for containers to drift across the ocean that long. Think about what that implies. Air freight runs at multiples of ocean freight. You only pay that premium when urgency matters more than cost. So when buyers accept the extra expense to secure metal immediately, the message is simple. Waiting risks losing access. In a tight market, available beats cheap. And this isn't just retail stackers scrambling for coins. This is wholesale industrial and investment demand in a market that cannot deliver fast enough at the current price. Wholesale demand doesn't need a viral headline to keep moving. It keeps pressing because orders still have to be filled. When a market starts air freighting silver, it's admitting the supply chain is broken. It's admitting physical availability is the bottleneck, not the quoted price. Now look back at Citi's $150 target with that in mind. When Citi models a $150 target in 0 to 3 months, they are not simply extending a trend line, they are building risk scenarios. They're asking, what if the wrong side is trapped, liquidity thins out, and the move accelerates faster than positioning can adjust? They see the same tightness Emmett is describing. They also see speculation piling on top, and they're effectively saying the structure is unstable, so the move can turn violent. Citi also stated they've been bullish on silver, both outright and relative to gold for many months, and remain so over the coming weeks. Outright bullish means silver up in absolute terms. Relative to gold means silver outperforming gold. Historically, that outperformance shows up when industrial demand is surging, or when silver is catching up after gold has already moved. Same direction, two ways, up and up faster than gold. Now let's talk about the speculative layers, because Emmett mentioned it directly. He said, you are definitely seeing more price action driven by short-term players in the future. Silver is usually less speculative than gold or equities. It's smaller, less liquid, and more industrial. But now, even the CEO of a major physical player is saying speculation is driving volatility. Why would that happen? Fear of missing out. If investors missed the gold rally or showed up late, silver becomes the high beta substitute. Bloomberg framed it as a big bet on macroeconomic turmoil and geopolitical risks. So silver turns into the faster, more aggressive version of the same trade, which pulls in momentum money. And when momentum money hits a thin market, price action gets explosive in both directions. Emmett called it a devaluation trade, money moving out of bonds and currencies into hard assets. But silver moves faster than gold because of the liquidity gap. Bloomberg noted that gold's daily London turnover is about 5 times silver's at current prices. That means it takes less capital to shove silver around. So when big money wants exposure and the market is thin, price discovery turns violent, up and down. That's exactly what we saw on Monday with the biggest intraday jump since 2008. That is not normal behavior. That is a market under stress. And both Citi and MKS PAMP are pointing at the same pressure. Now the technical picture matters too, even with all this fundamental heat. Weeks ago, silver pushed decisively above its 200-day moving average. Volume came in strong. On the daily time frame, the relative strength index is elevated, but not extreme. We've seen RSI divergences ahead of major moves, and right now, momentum is still building. The 50-day moving average also crossed up through the 200-day. That's the golden cross signal a lot of technical traders watch. In simple terms, the shorter-term trend is now above the longer-term trend, and when enough traders see the same signal, they often respond in similar ways, which can intensify the move. When fundamentals and technicals line up, the move can feed on itself. It pulls in more momentum-driven capital, and that capital reinforces price. So Citi's $150 target is not only a fundamental call, it's also an acknowledgement that technical momentum and physical reality are reinforcing each other. Now for the mid-video reveal, the part most people avoid saying out loud. I think the paper market is losing its grip on price discovery. For decades, COMEX futures and LBMA forwards have set the global silver price. Physical metal would trade at small premiums or discounts around that paper price, but the paper price was the benchmark. That system holds together when physical supply can meet demand at the futures price. But when demand overwhelms supply, when metal has to be air freighted to meet orders, the paper benchmark starts to matter less, not because paper vanishes, but because physical stress starts to dominate what buyers will actually pay. When physical buyers start paying whatever it takes, premiums explode. Arbitrage starts to break down. Futures markets either deliver metal or they move into backwardation. And if backwardation sounds complicated, keep it simple. It means the market is paying more for now than for later, because now is scarce. We're not fully there yet, but the cracks are showing. Emmett's comments about air freight and unprecedented demand are symptoms of a market shifting from paper-dominated to physical-dominated price discovery. And Citi's 50% target upgrade is their way of signaling the old models don't fit as well anymore. When a market moves from adequate supply into structural deficit, price has to rise until demand destruction shows up or new supply arrives. But new mine supply takes years. And industrial demand for solar, EVs, electronics, and defense is policy-driven. It doesn't halt just because price pops 10% or 20%. It adapts, absorbs the cost, and continues buying. Now, the bearish case, because balance matters and risk is real. First, volatility. Silver can surge 20% in a week, then hand back 15% inside 2 days. Emmett said short-term speculative players are driving price action. That usually means momentum traders, algorithms, and leverage. When leverage unwinds, corrections get brutal. If you trade silver with tight stops or high leverage, you can get stopped out on a spike down even if the long term thesis is right. That's the risk. Second, recession. A global slowdown can temporarily crush industrial demand. If solar installations stall, EV sales drop, and electronics demand weakens, silver gets hit. That's a real concern, especially if central banks raise rates aggressively to fight inflation. But the counterpoint matters. Even in recession conditions, green energy spending is politically entrenched. Governments subsidize it. It's tied to infrastructure policy. The energy transition is not purely market driven, it's policy driven, and that can make it more resilient to cyclical downturns. Third, supply response. Maybe a major new mine comes online, recycling jumps, or industrial users find substitutes. Possible, but unlikely in the near term. Mine development is a 5 to 10 year timeline. Recycling is already part of supply models and hasn't kept pace with demand growth. Substitutes exist for some applications. But silver's unique properties, especially conductivity, make it hard to replace across many high-tech and energy uses. Those are long-term buffers, not 90-day fixes. Fourth, Federal Reserve policy. If the Fed pivots back to aggressive rate hikes, real yields spike and precious metals can get sold. But current Fed rhetoric suggests a holding pattern, or potentially cuts if growth slows. Lower rates cut the opportunity cost of holding non-yielding assets like silver, and if inflation stays sticky even with higher rates, real yields can remain low or negative, which supports hard assets. Right now, the macro backdrop favors silver more than it hurts it. But I want to be clear. The risks are real. Silver is volatile. Citi's $150 target is a forecast, not a guarantee. Emmett's comments are observations, not predictions. Markets can turn fast. If you hold physical silver, be mentally prepared for pullbacks of 10, 15, even 20% before the next leg up. If you trade, understand that leverage and tight stops can shake you out even when you're ultimately right. Risk management is everything. Now let's talk about what this setup means depending on where you are right now. If you hold physical silver, this is validation. You're not imagining it. The fundamentals are real. The supply-demand imbalance is real. The industrial demand is real. And a major bank plus a major refiner just confirmed it on the same day. Patience is tough when price whips around. But structural bull markets rarely move in straight lines. They build, they consolidate, and then they explode when pressure gets too high. We may be approaching that explosive phase. If you're a trader, Citi's $150 target in 0 to 3 months is aggressive. If price hits 150 and the drivers are still intact, the next leg could be higher. But volatility cuts both ways, and Emmett's point about short-term players means momentum can reverse quickly. So use stops, keep position size under control, don't over-leverage. No one knows the exact path or timing, but the setup is there. If you're on the sidelines, you just got two huge signals. A global bank lifted a short-term target by 50%, and the CEO of one of the world's largest refiners said demand is unprecedented, with metal being air freighted due to urgency. You can shrug this off as noise, or you can dig in and ask whether the evidence actually supports the thesis. I'm not telling you to buy, I'm telling you to verify the data, think critically, and decide for yourself. Here are 3 takeaways to lock it in. 1. Citi and MKS PAMP both confirmed on January 27th that silver's market structure has fundamentally changed. A 50% target upgrade and unprecedented physical demand are not coincidences. 2. The drivers are structural, not speculative. Industrial demand, supply constraints, geopolitical fragmentation, and monetary policy are moving in the same direction. 3. The paper market's grip on silver pricing is loosening. When physical buyers are willing to air freight metal at massive cost premiums, the futures price stops being the real price. Availability does. The unresolved tension is timing and magnitude. Does $150 happen in 30 days, 60 days, 90 days? Or do we get a sharp correction first? Does speculative momentum amplify the move, or does it trigger a violent shakeout? No one knows. But the setup is there. The fundamentals are there. And the institutional plus physical market validation is now there. Do your own research. Verify every claim I've made. Know your risk tolerance. Don't invest money you can't afford to lose. Don't invest because of hype, fear, or somebody else's forecast. Invest based on evidence, logic, and a clear understanding of what you're doing. Move with logic, not hype. The metal guy out and about. Drop it in the comments, with physical urgency rising and paper strains showing what hits first, a quick $150 print or a nasty shakeout before silver drives higher.